Milton Friedman, Free to Choose, a Personal Statement. Prepare to embark on a journey through the world of Free to Choose, a Personal Statement by Milton Friedman, where you'll explore the implications of government intervention in economic matters. This book's summary highlights the importance of individual freedom in driving economic success and creating fairer societies, while dissecting the inefficiencies that result from heavy government control. As you delve deeper into various economic topics, such as tariffs, inflation, welfare, education, and labor unions, you'll discover how government interference often leads to unintended consequences, ultimately harming the very people it aims to protect. Stay tuned for a closer look at historical examples and a discussion on how limiting government power can lead to a more prosperous society.
The hidden cost of economic control. When governments try to control the economy in an attempt to level the playing field and create fair societies, they inadvertently constrain personal freedom and often make society less fair. This is evident when governments impose tariffs, which ultimately lead to reduced choice and increased consumer costs. Moreover, after elections, governments often spend taxpayer money in ways that don't align with individual preferences, further limiting personal freedom. Comparing historical examples like Japan and India, we see a clear correlation between free markets, individual freedom, and prosperity. Economic control by governments is often driven by good intentions, such as creating a fairer society. However, this control inadvertently results in more unequal societies and reduced individual freedom. One example is the implementation of tariffs aimed at protecting jobs and workers from competition. These tariffs end up hurting consumers by decreasing choices and increasing costs of everyday goods. Effectively, governments undermine our freedom to make choices with our own money. Additionally, we often witness governments making economic decisions that don't necessarily align with voters' preferences. This occurs when they spend taxpayers' money in ways that conflict with our personal values, limiting our freedom to choose how our money is spent. When we explore historical examples, there is a clear correlation between free market economies and individual freedom. In 1947, India and Japan underwent significant political changes that led to very different economic outcomes. Japan dismantled its feudal structure, implemented policies supporting social and economic freedom, and embraced free market principles. In contrast, India raised taxes, heavily restricted businesses, and controlled wages and prices. Consequently, Japan flourished with a wealthier population, while India's economy stagnated and its people remained impoverished. Evidence from various examples proves that economic control by governments diminishes personal freedom and may not result in the societal fairness they intended. Free markets not only stimulate economic growth but also encourage individual freedom, fostering prosperous and equitable societies. Lessons from banking crises. In the early 1900s, large banks in the United States had a system in place to curtail the damage caused by banking crises. When the economy faltered, healthy banks would unite to support unstable banks and restrict cash access for depositors. However, this approach faced political pressure, resulting in the creation of the Federal Reserve, the Fed, a central bank able to lend to commercial banks during crises. While the Fed initially restored confidence and mitigated crises in the 1920s, its approach during the Great Depression unintentionally exacerbated the situation. By decreasing available money instead of providing emergency loans, the Fed left banks in serious trouble, heightening the impact of the Depression. Throughout the early 20th century, banking crises in the United States were mitigated by healthy banks collaborating to offer loans to weaker banks, tempering panics and preventing bank runs. Although this approach sometimes led to short-term negative consequences for businesses and employees, crises would last merely a few months. However, after a series of bank runs in the 1900s, the government felt compelled to step in. The Federal Reserve, a central bank with the power to print or borrow money, was established. With the Fed's creation, a newfound sense of security and confidence in banks flourished among both citizens and bankers, as they believed their money would consistently be safeguarded. During the 1920s, the Federal Reserve lived up to these expectations by providing loans to struggling banks, mitigating crises. Regrettably, when the Great Depression struck, the Fed handled the situation differently. Instead of offering loans or increasing available money, as was anticipated, they reduced it, inadvertently contributing to the crisis. Banks, having become dependent on the Fed's emergency loans, failed to restrict their funds, operating under the assumption that everything was fine. Consequently, when the Fed didn't provide the expected support, banks plunged into chaos. The ensuing bank runs intensified the depression, which persisted for a decade. Unveiling the Hidden Tax. Inflation arises when the quantity of money grows faster than the supply of goods and services. This discrepancy between money and available products results in increased prices and a hidden tax, imposed on unsuspecting individuals. History proves that this phenomenon is indeed a direct consequence of unchecked government policies. As such, the ultimate remedy lies in curbing monetary expansion and limiting the amount of money created by authorities. In our world, inflation is an omnipresent yet subtle burden on our finances. It reveals itself when there's a disproportionate surge in the total amount of money as opposed to the volume of goods and services. This mismatch intensifies the demand for goods, leaving no choice but to boost prices to manage the demand. As a quiet menace, inflation effectively serves as a concealed tax on individuals. Picture saving $100 with expectations to purchase an equal value of goods. Should inflation be 3%, after only a year, that same quantity of items would cost $103, forcing you to part with an unanticipated 3% of your savings. Governments produce inflation through policy and actions like printing money. Historical accounts abound, like the American Civil War, during which rampant inflation was fueled by the continuous printing of money to fund warfare. A striking 10% monthly inflation from 1861 to 1864 ensued, with plunging control over consumer goods costs. Only after the war, when the flow of newly printed currency ceased, did inflation recede. Presently, in America, inflation occurs due to rapidly expanding government expenditure and the Federal Reserve's misguided policies. Politicians wield the power of the printing press to finance their pet projects, without directly having to raise taxes, appeasing their special interest supporters. The government's control over the Federal Reserve permits uninhibited money creation without requiring citizens' explicit consent. To reverse inflation's silent, disruptive presence, a decrease in monetary growth is imperative. The key lies in implementing constraints on money generation by governmental institutions. Flaws of the welfare state. The modern welfare state, while well-intentioned, is far from the most efficient way to assist the poor and underprivileged. Government bureaucrats controlling funds leads to spending without incentives for frugality, adversely affecting the efficiency. In addition, redistributing income through programs such as Social Security can disproportionately hurt the poor through regressive taxes. The poor are also placed at a disadvantage as they have fewer political connections and are subject to loss of funds to legislators, campaigns, and regulators. A better approach is allowing individuals to have the freedom to spend their own money charitably, leading to more beneficial outcomes. In today's world, the welfare state tries to help the less fortunate, but it falls short in providing efficient support to those who need it the most. When government officials manage funds, it dramatically affects how they spend money. Since they are dealing with someone else's money for people they don't know, the natural instinct to be wise spenders is lost. In contrast, if people manage their own money, they strive to get the best outcome even when contributing to charities. Furthermore, the welfare state creates more problems for the economically disadvantaged. Government-driven efforts to redistribute wealth can actually lead to adverse effects on the poor. For instance, Social Security, a tax that tends to burden low-wage earners disproportionately, results in wealth transfer from the poor to the wealthier retirees. Such illogical dynamics only add to the woes of those in need. Another issue is the political vulnerability of the poor. With little to no connections, they struggle to secure much-needed resources when it comes to the political competition for funds. Moreover, the actual amount that makes it to welfare programs is reduced as a significant portion is siphoned off to legislative expenses, political campaigns, and regulators, leaving the poor devoid of benefits. Ultimately, the welfare of the underprivileged is best promoted when individuals can freely spend their own money charitably. The innate human compassion and self-interest guide wise, efficient decisions, creating a better support system for those who need it. Centralization's educational decline. Over the past few decades, the quality of public education has seen a decline due to increasing centralization in Washington, D.C. In the early 19th century, schooling was widespread despite the lack of free, compulsory education. However, the 1840s saw a push for government-controlled schools, led by those who sought higher pay and security through regulation. This centralization resulted in negative effects: larger schools and classrooms, diminished school choice, and expanding administrative power, spiraling further as higher funding fails to solve the issues. Disadvantaged students are most severely impacted, since financial constraints limit their schooling options, unlike their wealthier counterparts who can access private education or better-funded districts. Public education policy must address parental voice, quality concerns, and the unfortunate centralization consequences for meaningful improvements. Consumer protection paradox. There exists an assumption that government regulations safeguard consumers from predatory sellers and substandard products. However, this protection frequently leads to poorer conditions for consumers. Stricter regulations impose heavy costs on industries, which in turn raises prices and slows economic growth. This can contribute to unemployment and wage stagnation. Historically, economic growth has suffered following the formation of regulatory agencies, with a notable example being the New Deal in the 1930s. Government intervention can also limit competition by supporting powerful special interests. An infamous case was the creation of the Interstate Commerce Commission, initially formed to regulate the railroad industry. Instead, it led to railroad companies writing their own regulations, driving up prices and hindering new competitors from entering the market. The most effective way to protect consumers is to encourage competition and reduce regulations. In a competitive market, businesses must offer better products and lower prices to attract consumers, thereby naturally benefiting the public. Illusions of union benefits. Over the last 2 centuries, working conditions have improved dramatically in economically advanced societies, but not because of governmental or labor union intervention. Surprisingly, unions often negatively impact unemployment and wages. Government-granted privileges geared towards benefiting union workers often leave non-union workers unemployed or facing reduced wages. A notable example is the American Medical Association, which keeps the number of doctors low, increasing the cost of medical care. Unions try to enforce high wages, but this approach is artificial and destructive. The minimum wage in the United States, though intended to protect workers, leads to high unemployment and severely impacts poor black teenagers. These teenagers often don't have the skills necessary to command a high-paying wage, yet, they cannot take low-paying jobs that could allow on-the-job training. The minimum wage eventually protects skilled workers at the expense of the less skilled ones. A more effective approach to the labor situation is leaving it to the free market. In a free market, workers and employers have a wider range of job options, giving them a natural way to avoid exploitation. Dismantling government overreach. The relentless growth of government power has resulted in inefficiency and a disconnect between citizens and their government. By introducing broad rules and an economic bill of rights, we can limit the government's power, thereby promoting a healthier balance of power and safeguarding our freedom. As the government's power expands, it increasingly controls numerous aspects of our lives. Regrettably, this growth has led to escalating costs and inefficient spending. Take, for instance, Washington, D.C., where one set of government employees funds campaigns to quit smoking while others simultaneously subsidize tobacco farmers. Incredibly, taxpayers foot the bill for contradicting policies. This expansion of government authority has made it harder for citizens to comprehend their government's actions. With a constant influx of new laws and agendas, it is virtually impossible for the average person to understand the full scope of government operations. The need for bureaucrats to manage these complexities only widens the chasm between the people and their government. To restore power to citizens, we must establish comprehensive guidelines defining the government's limitations. One promising proposition is an economic bill of rights, constraining the government's influence in economic matters. By capping the total government budget, we can reduce politicians' capacity to pander to special interest groups. Consequently, everyone would compete for a share of a finite resource, as opposed to conspiring with the government to inflate the budget annually. The most significant danger to human freedom is the concentration of power, be it governmental or otherwise. It is crucial to remember that even well-intended power can have adverse effects on our liberty. Thankfully, the choice to determine our nation's path remains in our hands, and it is our responsibility to avert further consolidation of power.
In summary, Free to Choose, a personal statement, sheds light on the negative effects of government intervention in various aspects of the economy, from tariffs and inflation to education and labor unions. Aspiring to make societies fairer, these measures often backfire and limit individual freedom, hindering economic prosperity. The book advocates for increased competition and decreased regulation to drive economic growth and improved living conditions. The key takeaway is that individuals must recognize the connection between economic freedom and personal liberty, reining in government power to take back control over their own lives. Ultimately, fostering a society that champions individual freedom and market-driven solutions will lead to a thriving, fair, and prosperous future for all.